Are you worried about rising interest rates? It's a question that resonates with many of us, especially when we think about our mortgages, auto loans, and other debts. But to fully understand why this is a concern, we first need to understand what interest rates are and how they work. Interest rates in their simplest form are the cost of borrowing money. Think of it as the price you pay for the privilege of using someone else's cash. Now, this price isn't set in stone. It fluctuates, much like the value of a stock or a piece of real estate. And when it rises, we say we're in a period of rising interest rates. But what causes these rates to rise and fall? Well, it's a combination of factors, including the health of the economy, inflation, and the actions of our central bank, often referred to as the Federal Reserve in the United States. When the economy is strong and inflation is a concern, the central bank may raise interest rates to cool things down a bit. Conversely, in times of economic downturn, it might lower rates to stimulate growth. Now, rising interest rates can make loans and debt more expensive. That's because the interest, the cost of borrowing, increases. So if you've taken out a mortgage to buy a home or a loan to purchase a car, your monthly payments could go up when interest rates rise. And if you're carrying a balance on your credit cards, the interest you owe each month could also increase. This can seem a bit daunting, especially if you're juggling various financial commitments. But it's important to remember that understanding the mechanics of interest rates is the first step to managing them effectively. And that's precisely what we're here to help you do. Now that we understand what rising interest rates are, let's delve into what they mean for your mortgage. And in the process, we'll share some strategies that could help you save money, even in a rising rate environment. So, how do rising interest rates affect your mortgage? Well, when interest rates rise, the cost of borrowing money increases. This means if you have a mortgage, you could end up paying more each month. But how much more you'll pay depends on the type of mortgage you have. You see, there are two main types of mortgages: fixed rate and adjustable rate. A fixed-rate mortgage has an interest rate that stays the same for the life of the loan. Whether interest rates rise or fall, your monthly payment will stay the same. This predictability can be a comfort, especially in times of rising rates. On the other hand, an adjustable-rate mortgage, or ARM for short, has an interest rate that can change over time. The rate is typically fixed for a certain period, say 5 or 7 years, and then it adjusts periodically based on changes in a reference interest rate. If the reference rate goes up, so does your mortgage rate and consequently your monthly payment. Now, you might be thinking, who would want an adjustable rate mortgage if rates are rising? Well, ARMs usually offer a lower initial rate than fixed rate mortgages, which can make them attractive. However, the risk of future rate increases is something to consider. It's also important to understand that the impact of rising rates isn't limited to your monthly payment. Higher interest rates also mean you'll pay more interest over the life of your loan. For instance, if you have a 30-year mortgage, even a small rate increase can add up to a lot of extra interest over those 3 decades. In essence, rising rates can make your mortgage more expensive. This can be a tough pill to swallow, especially if you're already stretched thin. But don't lose heart. There are strategies to manage the impact of rising rates, and we'll delve into those in the next scene. Rising rates can make your mortgage more expensive, but don't worry, there are ways to manage this. Wondering how to save money on your mortgage despite rising rates? Well, let's dive right in and explore some actionable tips. First off, consider a fixed-rate mortgage if you haven't already. Unlike adjustable-rate mortgages, a fixed-rate mortgage locks in your interest rate for the life of the loan. This means you're shielded from rising rates. Your monthly payments remain steady, making it easier to budget and plan ahead. Next, let's talk about making extra payments. Imagine you get a bonus at work or find yourself with some extra cash. Consider making an additional payment on your mortgage. This isn't just about paying off your home sooner. By reducing your principal balance, you're also reducing the amount of interest you'll pay over the life of the loan. Even small extra payments can add up to substantial savings over time. Now, refinancing is a term you've probably heard before. Essentially, it's about replacing your existing mortgage with a new one. hopefully with a lower interest rate. However, it's crucial to time your refinance correctly. Refinancing when rates are high could mean you end up paying more over the life of your loan. So keep a close eye on the market and consult with a financial advisor if you're unsure of when to refinance. Remember, every penny counts. Reviewing your escrow payments can also lead to savings. These are payments included in your mortgage that go towards things like property taxes and homeowners insurance. If these costs decrease, you could ask your lender to recalculate your escrow, which could lower your monthly payments. Finally, consider bi-weekly payments. Instead of making one monthly payment, you make half your mortgage payment every 2 weeks. This results in one extra payment each year, which can shave years off your mortgage and save you thousands in interest. But mortgages aren't the only loans affected by rising rates. Let's talk about auto loans. How do rising interest rates impact your auto loan? A question that triggers the curiosity of many. Let's dive into it. When rates go up, borrowing becomes more expensive. This is equally true for auto loans as it is for mortgages. Think of it like this. You're not just buying a car, you're also buying money from the lender. The cost of that money is the interest you pay. So when interest rates rise, the cost of the money you're buying goes up, and so does the overall cost of your car. Let's bring it to life with an example. Imagine you're buying a car for $25,000. You're borrowing the full amount for 5 years. If the interest rate is 3%, your monthly payment is around $450. But if that rate jumps to 5%, your monthly payment goes up to around $470. That's an extra $20 a month, or $1,200 over the life of the loan. That's enough to cover a good chunk of your auto insurance or a year's worth of gas. So how can you mitigate the effects of rising rates on your auto loan? Firstly, shop around for the best rates. Don't assume the rate offered by your car dealer is the best one. Check with banks, credit unions, and online lenders. Secondly, consider making a larger down payment. The less you borrow, the less interest you'll pay. Remember, a car is a depreciating asset. It loses value over time. So borrowing more than you need to, especially at higher interest rates, can leave you in a sticky situation where you owe more on your loan than your car is worth. So it's wise to borrow as little as possible and aim to pay off your auto loan as quickly as you can. Rising rates can affect all kinds of loans. Let's summarize what we've covered. How can you manage and save money amidst rising rates? Let's take a moment to summarize the key points we've discussed in this video. First, it's crucial to understand how rising interest rates work. These rates, set by central banks, impact the cost of borrowing money. When rates rise, so does the cost of your loans, including mortgages and auto loans. The more you owe, the more you'll feel the impact of these rate increases. We then dove into the specifics of how rising rates can affect your mortgage. When rates increase, the amount of interest you pay on your mortgage also goes up. This could mean higher monthly payments or a longer repayment period. However, there are ways to mitigate these effects. For example, refinancing your mortgage when rates are low could lock in a lower rate for the life of your loan, potentially saving you thousands of dollars. Moving on to auto loans, rising rates can also affect your monthly payments and the total amount you end up paying for your vehicle. Again, refinancing at a lower rate when the opportunity arises could help you save money. But what can you do to manage these rising rates? There are a few key strategies. Firstly, stay informed about the economic climate and interest rate forecasts. Secondly, pay off your debts as quickly as possible to reduce the amount of interest you'll have to pay. Lastly, consider refinancing your loans when rates are favorable. Being proactive and informed is critical when it comes to managing your loans in a rising rate environment. By understanding how these rates work and how they can affect your finances, you can make informed decisions that could save you a significant amount of money in the long term. So to wrap it up, rising rates don't have to be a cause for panic. With a little planning, knowledge, and proactive management, you can navigate these changes and potentially save money on your loans. Remember, knowledge is power when it comes to managing your loans in a rising rate environment.